How do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is
Hello friends, today we are diving into the wisdom of Howard Marks, one of the greatest investors of all time. I've distilled the most powerful insights into 5 key principles that will transform your approach to investing. These aren't just simple tips, they are complete mental frameworks. They are an introduction to second-level thinking, a concept that Marx is explaining in depth in his book, The Most Important Thing. It is a way of looking at the world and at the stock market that allows us to find opportunities that other investors are missing. And I encourage you to stick till the end because you will also get some extra wisdom from Howard Marks.
how do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is buying things for less than they're worth. So if you buy a high-quality asset, you know, and I say in the book, there's a guy on the radio, I used to, when I lived in LA, I listened to NPR on the way to work. And there was a guy and I heard him say it. He said, well, if you go into a store and you like the product, buy the stock. It couldn't be more wrong. Because what determines the success of an investor is not what he buys, but what he pays for it. And if you buy a high-quality asset, but you overpay for it, you're in big trouble. And you can buy a very low-quality asset, but if you pay less than it's worth, chances are you're going to make money. So the book says, chapter 3 says, the most important thing is value, figuring out what the value of an asset is. But chapter 4 says the most important thing is the relationship between price and value. So let's assume that you're able to figure out the value. If you pay more than that, you're in trouble. If you get it for less, the wind is at your back.
The real secret to success in investing is buying things for less than they are worth. This might sound obvious, but it's actually profound. Most people focus on buying good assets rather than focusing on the price they pay. Nvidia is a backbone of AI revolution. Buy. Microsoft controls ChatGPT. Buy. Tesla has the best self-driving. Buy. But we are investors. We want to buy great companies because they are more predictable, or they have a better chance of winning against competitors, or they have some other moat. But if we are overpaying, if we are following the crowd, we are not putting ourselves in a great position. As Marx put it, you can buy a very low-quality asset, but if you pay less than it's worth, chances are you are going to make money. What determines your success as an investor is not what you buy, but what you pay for it.
The first one says that the most important thing is risk control. And we tell the clients, we think that for excellence in investing, the most important thing is not making a lot of money. It's not beating the market. It's not being in the top quartile. The most important thing is controlling risk. That's our job. That's what we'll do for you. And the clients come to us who want to invest in our asset classes with the risks under control. There are other people who put less emphasis on controlling risk, and they have better results in the good times and worse results in the bad times. Our clients want what we give them. Number 2, we have an emphasis on consistency. So we say we don't try for the moon at the danger of crashing. You know, the first memo that I wrote in 1990, I'm sure you remember that, Rob, talked about a guy who was head of an asset manager that had a terrible year. And he said, well, it's very simple. If you want to be in the top 5% of money managers, you have to be willing to be in the bottom. I have no interest in being in the bottom 5%. I don't care about being in the top 5%. I want to be above the middle on a consistent basis over the long term. And there's a funny bit of math. This will confound the, what do you call yourself, data scientists? This will confound the data scientists in the room. But so in that first memo, I contrasted the comments from that money manager with a comment from one of my clients who told me right about the same time, it was the juxtaposition that caused me to write that first memo. He told me that for the previous 14 years, his pension fund had never been above the 27th percentile or below the 47th percentile. So it was solidly in the second quartile every year for 14 years. So let's see, 27, 47, the average of that is 37, right? What percentile do you think that fund was in for the whole 14 years? 4. And if you think about it, it's really almost mysterious. Why the 4th, not the 37th? And the answer is that when people blow up, they really blow up. And so we said we want consistency. We want to be a little bit above the middle all the time. Maybe we'll pop up to the top in the years when the markets are terrible and our risk control is rewarded. But we think that over a long period of time, we'll be very respectable that way, and our clients will have an absence of bad experiences, which I think for them is very important.
If we want to achieve great results, we shouldn't concentrate on making a lot of money. We should concentrate on controlling our risk. Mark's philosophy is captured perfectly in his statement, "I don't care about being in the top 5. I want to be above the middle on a consistent basis over the long term." That shows the power of consistency, security, and risk control. That is second-level thinking. Not trying to be the best, but trying to be above average for the longest time possible.
There are two kinds of winning tennis players. If you look at Pete Sampras or Nadal or Djokovic, how do they win? The winning champion tennis player wins by hitting winning shots. He hits shots that the opponent can't return. The amateur tennis player, like him and me, we win not by hitting winners, but by avoiding hitting losers. And we believe that if we can just push it back 20 times and just get it over the net 20 times, our opponent can only do it 19. We believe that we'll outsteady him, outlast him, and eventually he'll hit it into the net or off the court. We'll win the point. But we'll win the point without having hit a winner. So there are obviously two styles of tennis. And so the same is true for investing. So Charlie Ellis wrote an article called The Loser's Game. And he said he thought that investing is a loser's game. And so the best way to win at tennis is at investing is by not hitting losers. Now, I believe also that it's a loser's game, not as much as Charlie believes, and not for the same reason. Charlie believes that investing is a loser's game because the market is efficient and securities are priced right. I believe there are inefficiencies. I just think it's hard to consistently take advantage of them, and you have to be an exceptional person to take advantage of them on a consistent basis. You know, in scoring tennis matches, they keep track of something called unforced errors. And the reason they keep track of them is because there are so few. The pro doesn't make a lot of unforced errors. We make unforced errors all the time. And so in order to survive, we have to avoid them. So the point is, if you're going to be an investor, you have to decide, am I good enough to go for winners? Or should I emphasize the avoidance of losers in my approach?
This article called The Loser's Game deeply influenced Howard Marks, and I believe we should also think about our strategy through this perspective. We should remember that we don't win by hitting spectacular winners, but by avoiding losers. That corresponds beautifully with the previous point of risk control. Charlie Munger said that we should never disrupt the compounding effect. We have to give it time to do its magic. And it is similar here. We have to stay in the game long enough without making any silly mistakes to come out on top. This idea became central to Marx's philosophy, eventually distilled into Oak Street's motto, "If we avoid the losers, the winners will take care of themselves."
Now, I don't believe in forecasts, macro forecasts. People who forecast interest rates, performance of economies, performance of stock markets. And I don't think that my efforts to be a superior investor and most other people's are aided by macro forecasts. Am I saying that the forecaster is never right? No, I'm not saying that. The forecasters are often right. Last year, GDP grew 2%. Many forecasters forecast that GDP will grow this year at 2%. That's called extrapolation. And usually in economics, extrapolation works. Usually the future looks like the recent past. So usually the people who forecast a continuation of the current are right. The only problem is they don't make any money. Because let's take the economy. Most people forecast 2-something for this year. A growth rate of 2-something is cooked into the prices of securities today. If the growth rate turns out to be 2-something, everybody who forecasted that will be right, but security prices will not change much because that 2-something growth was anticipated and discounted a year or two ago. So all those people who are right won't make any money. Logically, am I saying that forecasts never make any money? No. The forecasts that make money are the forecasts of radical change. If everybody's predicting 2.4% growth for this year, and if I predict -2, and it turns out to be -2, or I predict 6 and it turns out to be 6, I'll make a lot of money. So forecasts which are not extrapolations, forecasts which are radically different from the recent past, are potentially very valuable if they're correct. Of course, they're not of any value if they're incorrect. And then if they're incorrect, they'll cost you a lot of money. If everybody else thinks it's going to be 2.4 and you predict 6 and it turns out at 2.4, you're probably going to have taken the wrong investments and lost a lot of money. So deviant forecasts, which turn out to be right, are potentially very valuable, but it's very hard to make them. It's very hard to make them correctly. It's very hard to make them correctly consistently.
This is another point that aligns with Warren Buffett's belief that macroeconomic trends and predictions should not influence our investment decisions. I really like the way Marx explains his philosophy when it comes to forecasts. Basically, if you want to beat the market, then forecasts are not very helpful. To beat the market, you have to be a contrarian. But there is a catch. You need to be a contrarian and you need to be right. That's extremely difficult. You need radical change to get extraordinary results. But radical forecasts are very seldom correct. So investing, by believing them, can get you into a lot of trouble if you just follow them blindly. So it's not that forecasts are always wrong or that they are misleading. It's just that they can't really be of any help for us as investors trying to beat the market.
In investing, there's a lot of randomness. And if you look at investing as a field without randomness, where everything is determinative, you'll get confused because you will not draw the proper inferences from what you see. For example, you see somebody and they report a great return for the year. The scientist who thinks that the investment world runs like the world of physics might think, well, great return, that means the guy's a great investor. But in truth, it might be somebody who took a crazy shot and got lucky. Why? Because there's a lot of randomness in the world. You can't tell from an outcome, whether a decision was good or bad. It's very important. Most people don't understand this. Totally counterintuitive. Good decisions fail to work all the time. Bad decisions work all the time. The investment business is full of people who are, quote, right for the wrong reason. Made a bad decision. It didn't work out the way they thought, but they got lucky and they were bailed out by events. And so for every possible phenomenon, there is a range of things that can happen. There may be one where it's possible to discern which one is the most likely. And if we draw a probability distribution, that may be the highest point on the distribution, the most likely single outcome. But that doesn't mean it's going to happen. And the reason we don't have many probability distributions that look like this, but rather that look like this, is because a range of things can happen. And it's very, very important to notice that, number one, there are lots of things that can happen, so you have to allow for them. And number two, the thing that is most likely to happen is far from sure to happen.
If we make an investment decision and it does not go the way we anticipated, it may mean that we were wrong, but it's not certain. Good decisions can fail due to bad luck, and bad decisions can succeed due to good luck. We have to understand this because we may draw wrong conclusions from the results of our decisions and either repeat the mistakes or never again make decisions that could actually make us money in the long term. And the second point is that being too sure, betting it all on one position because it is a sure thing, can get us into a lot of trouble. Like we heard before in this great quote from Mark Twain, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so."
First of all, what the wise man does in the beginning, the fool does in the end. In every trend in investing, it eventually becomes overdone. If you find an asset which is cheap and buy it, that's great. If everybody else figures it out that it's cheap, then it'll go up. Then people see that it's rising and more people jump on the bandwagon, goes up, up, up. And the last person to buy it is a fool. And the first person to buy it is a wise man. It's the same asset, just at different prices. And as people say, first the innovator, then the imitator, then the idiot. So that's another way to look at this adage. Number two, never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average, kind of like that skydiver who's right 98% of the time. It's not sufficient, depending on how you want to live your life, to survive on average. We have to survive on the bad days. So we have to be able to survive the low spots in the stream. Your portfolio has to be set up to survive on the bad days, so you won't be shaken out of your investments. And then finally, being too far ahead of your time is indistinguishable from being wrong. And yet that's a great challenge because, as I said before, the things that are supposed to happen will not necessarily happen, and they absolutely will not happen on time. So you have to be able to live until the wisdom of your decisions is proved, if at all. So all of these things, I think, say something about modesty and humility of belief rather than cocksureness, which I think is the greatest risk.